what does it mean actually to be net long while short or net short while long?
So what I'm basically trying to express with that title is you can have two positions on in the same name, the same stock, without going into options. Okay, and that's really what I was trying to get across to people. A lot of people think the only way to, let's say you're in a longer term long, okay, which is what I'm going to illustrate. You're in a longer term long and somewhere, you're profitable and it looks like it's going to reverse. And you say to yourself, well, if I wasn't in this long, this is a very proper short signal for me. Well, you can keep the long while expressing the short trade and not have to borrow and put on two separate positions in two separate accounts, where some brokers allow you to hold two separate positions in the same account. You pay double fees on that if you do that. And there's a way to actually make yourself synthetically short if you're in a long, or synthetically long if you're in a short, without using options. I want to stress that. A lot of people say, well, the only way to do it is options. That's not true. And it has a lot to do with you, the way you track your positions on the personal ledger. Okay, not in your brokerage account, but on your personal ledger. And at the end of this, I'll recommend that you keep a personal ledger to keep track of things correctly.
Right. And is there any risk involved on this strategy?
There's actually less risk on this strategy than getting involved in options. And the reason I say that is because options have a time limit, right? You have to not only predict a new move versus the position that you're already in, but you have to predict the time frame that it's going to happen in. So I would argue this is actually less risky. Now, I'm not talking about selling covered calls. That's something that I'm not going to discuss in this class, because people say there's no risk to that. There is. There's a lot that can happen during that strategy, and that's not something I'm going to be covering in this series of lectures. But in this particular strategy, there's actually less risk than there is in another strategy. And I'll explain why as we go through the example.
Good morning. If you would, you can start sharing your screen. Sure. And explain the strategy to us. Well, thank you.
I'm going to start out with a chart that I've actually talked to you guys about. Okay, I'm going to be talking about, I'm going to share my full screen here. And I'm going to open up Zero Pro. And Badish, I just need you to confirm that you can see this right now. Okay.
That's clear to me now, yeah.
All right, so I've talked about FANG, both FANG is Diamondback Energy, FANG, over 1.4 million shares on average traded a day. It's a liquid stock. It's not low price like a lot of people like, but it is a very tradable name. Okay, now, back here last year, I went on TV and said that I had a long signal for FANG. Now, full disclosure, I got out of this long a while ago, okay? But I've calculated a new target for this particular stock if this were a longer term long for somebody, and that target's $215. But you can see the high of this particular move, which is really the all-time high, is 211. I think that's 211.96. I don't have my glasses on, and I'm not going to put them on, but I think it's 211.96. All right. My long trade was here. Now, my stop on this particular long trade was this red line. Okay. And you could see this red line, you can see it right here, is about 133.42. Okay. 133.41, 133.42. So I'm going to pull up the position size sheet with a $10,000 account, which is not my account, it's fictional. But I'm going to show you guys how many shares in this particular signal with this particular stop somebody could put on in this trade. Okay. And I don't want to go into why this is a signal, but if you've ever seen me talk about the rotation zone, you can tell why it's a signal. And I did a session here about picking stops or tracking stops that will explain why I picked this particular level as my stop. But we're not going to talk about that right now. We're just going to talk about the example. Now, I've talked to you guys in the past about double tops and double bottoms. Well, we got up here and we rallied to this area right here. So you got the high here of 208.85, and you got the high I've already mentioned of 211.96. Diamondback Energy, FANG, formed a technically correct double top, which is a reversal pattern. So just by nature of the name, if you see a double top and it's a reversal pattern, that would mean a move lower, right? A double bottom, which is also a reversal pattern, which, by the way, this is not a double bottom here. We can do that another time as well if we want to. A double bottom is a reversal pattern, and just by the name being bottom, the reversal move would be up. Now I'm pointing to this, but this is not a double bottom. I need to continue to stress that. So this double top, you're sitting there going, well, I'm long. My target is higher than the all-time high, but there's a double top here. Do I just let my profits erode, or do I get into a short position and get out of my long position? Remembering the sessions where I told you that every position is different in terms of position size, in terms of your risk per trade, right? You don't want to just exit all of your longs because you may lose some of the profit going up to the 215 target, right? So how do I do it? This is what I'm talking about when I talk about net long, but taking a short. All right. So I'm going to go through the steps of that right now. In my risk position calculator, I've got both trades explained, and I'm going to switch to that now. Go here. I'm going to share a different screen. Here is my position size calculator, and here is the original trade on the left-hand side. Okay, you can see I've got the name FANG in here. I've got the entry price of $141.24. This is a $10,000 account with 2% risk. Okay, so 141, $200 max risk per trade, which is 2% of $10,000. Stop price of $133.42. The risk is $7.82 per share. And in order to stay within my $200 or 2% max risk per trade, this gives me 25 shares that I can take on the long side for an actual risk of $195.50. So I took that trade back in October, right? I don't have a $10,000 account, but that's not important. Let's say that I do. So I took this trade back in October. Now, I already told you guys I had a target of $215, right? Again, that part is fictional. I need to stress that. So now I see that double top forming, and I say, okay, what do? Do I exit this, right? Do I open up a separate short trade, or do I just leave it alone on the risk that my trade collapses and goes all the way down to my stop, right? Instead, what you can do is calculate an entire separate trade, which I did here on the right side of the sheet. Now notice that I put in $9,805 of risk capital. That's because this $195.50 is still at risk. So I took this $10,000 minus the risk of the trade that I already have on, and that's my investing capital. So my 2% risk per trade is now not $200, it's $196. Okay, so the entry price is going to be about $203.50, which is the trigger for the double top. The stop on this is $212, which is above the all-time high, but also above a level in the particular trade setup that I'm not going to discuss. The risk is $8.50 per share. My maximum risk for this trade is $196.09 or 23 shares. Now there's a slightly incorrect calculation here, but you can see that the actual risk of this trade is $195.50. If I short 23 shares at $230.50 with a $212 stop entry. So I'm going to sell 23 shares at $203.50. Now, do I need to then go and borrow the stock and sell 23 shares? No. I cover 23 of the 25 longs. That's how I do this. So now what do I have in reality in my brokerage account? I'm long 2 shares. But what am I looking at in my personal ledger? All right. I'm going to show you in my personal ledger what I'd be looking at. And again, this is a fictional personal ledger. Okay, but it's one that you guys should all have. Here's an Excel spreadsheet. You notice that I've got a long tab and a short tab. You also notice my P&L, I only have in percentages. I don't have it in dollars in this sheet. This goes along with my theory, okay, that you shouldn't look at dollars while you're in a trade. Now, if you know Excel very well, you can have current prices piped in from certain platforms, okay? I put this price in a couple days ago, and I'm just going to leave it there. Actually, no, I'm going to use the current price. What's the current price of FANG right now? Last trade is, it's pretty close, 197.69. So I'm going to go ahead and put 197.69 into this sheet. You're seeing me type this, right, Badish? I didn't hear you answer if you answered. I'm going to assume you're saying this. Okay. My entry price is 141.24, and my stop price is 133.42, and my target is 215. I've got 25 shares on at this price. Okay. Currently, the stock is up 40% from my entry price. However, with 25 shares, my percentage portfolio gain or loss is 14.1% versus this $10,000 here. But I've also gone on a short, don't I? I'm short 23 shares, right? Now, remember the current price, 197.69. So I'm going to put in the current price of 197.69. All right. On this particular trade, I'm short 23 shares, right? I have a gain of, the stock has dropped 2.9% from my entry level, and I'm up 1.34% on my portfolio. Now, this I've calculated versus $10,000. Okay. I can also calculate it versus the 8,000 I mentioned before, but I want to keep it consistent. So why am I able to say that I'm long 25 and short 23? Because this gain is offsetting the loss from 203, the entry price in this position. It's offsetting it. So now instead of being long 25 and watching the market drop, I'm only long 2, which is salvaging this position for me. All right? That's what's happening in reality. But in your own personal ledger, you're looking at a long trade of 25 shares and a short trade of 23 shares in the same name. That's what you're actually doing with that too long. Okay, now, if I get to my target of 185.83, what's going to happen there? I'm sorry, 185.33. If I get to this target, I'm buying 23 shares. That means I'm reinstituting my full long trade. I'm long 2 plus 23. That puts me to back long 25. But what did it allow me to do? It allowed me to average my price at a better level versus had I taken that downdraft on all 25 shares. So it's like I took profits on 23 of them, and then I reestablished the position at this 185.33. The net result is the profits are in your account, and now you're reestablishing the trade with those profits in your account from the short trade, which effectively is saving the profits from the long trade. Saving profits that you would have lost on the long trade if it moved back down to 185.33. So effectively, you are short and long at the same time while you're net long 2 shares. So that's what keeping this ledger does for you. If somebody says to you, maybe you go meet a couple of other drinks for traders with other traders after the close, what position you got on? Well, right now I'm long 25 FANG and I'm short 23 FANG. Oh, did you do it in options? No. Oh, did you borrow 23 shares and short those in another account? No. I don't want to pay the fee, the interest to borrow the shares. So essentially what I did was cover 23 of my longs. And then when I got to my short target, I put those back on. and I saved those losses on 23 shares. Now, when you move back up, what's happening? If you start to move back up, you'll say, okay, thank God, those losses I had are now, I'm recovering those losses. But you're not recovering those losses now. Those are added gains. So that's what I mean when I say this, okay? That you're actually able to be net long and net short at the same time without using options. And if you just do it in demo for a while and kind of mess around with it, okay, maybe you can have two separate demo accounts. And you could do one where you just leave the long on and another one where you do a smaller short and then add the long back on at the target of the shorts. And you'll see that your account is larger with the synthetic short than it is with actually covering the long or with actually leaving the long in place, number one, or with borrowing shares to shorten another account that you have to pay interest on when you borrow shares. You have to pay fees on those borrowed shares. So this is what I mean. You don't have to delve into options to have a synthetic position on something that you're already long. And I do this all the time rather than sell covered calls, which is something that I'm able to do, right? I'll take a short position synthetically by covering some of my longs. And I track them differently because the reason you want to track them differently is you only want to do this if you have an actual short signal, not just because you think it may be overdone. Not just because you think, wow, this ran a long way, it's probably going to come down. I'm going to cover some and put them on again later. Because if you do that, you don't have a plan for that covering and re-adding. You don't have a plan.
I have a question, Landry. Hi, everyone. I don't understand very well, so you don't have to borrow a stock that you're already long.
Well, what I'm saying is you don't have to put on a short position. Okay. And you're right. If you're already long the stocks, you could use those stocks to short, but you're essentially doing the same thing. If you're shorting, you're covering some of the long. It's the same trade. So you only want to do that if you have a short signal, right? So my point is, if you want to establish another short, if you're not just covering longs, and psychologically, these should be two different things. If you're just saying, I want to get out of a few of my longs because we got close to my target, that's completely different. Right? If you're going in a direction of saying, I've got a short trade, what should I do here? I've got a short signal, I'm short of my target. Some people might go into a different account and short it. And if you do that, you have to borrow it, right? You have to borrow the shares. You can't do it. If your broker allows you to do it in the same account, then you're already doing exactly what I'm telling you to do, right? But some people will go into a different account to short, so that they can have two positions. I'm arguing, don't do it in a different account. Just track it for yourself differently in order to not offset the longer term long you've already had on in a different account.
Great question. Is there any cost difference if we use our stocks or borrow another stock?
Is there any what?
Cost difference on the fees?
No, if you're using your own stocks, there's no cost difference because you're not borrowing. You're using stocks that you're already long. And that effectively is what I'm telling you to do, is to not go off. Some people don't like to do it because they just aren't able to track the trade with no emotion. What I'm trying to tell you guys to do is to set up a different trade in what I call your personal back office. And then that's how you cover longs and re-add at a correct price. I'm trying to illustrate that a lot of people, when they do that, will not re-add the long if they think it's going to go lower. But if you have a target for your short trade and you're tracking it differently in your own personal back office, that's what I keep calling it. Your Excel spreadsheet is your personal back office, right? So if you're doing it in the same account where you don't have to borrow, you want to track it as a separate trade in your own back office. You don't want to just blindly, I'm going to sell some here, I'm going to buy them back here. Because then where's your stop? Where's your target? If you're not tracking it, you don't know where those are. And you're breaking the rule that you theoretically kept in the first trade.
Thanks, Limbo. Well, we have a few more new attendees after we start. If you would like to just recap what you covered and people can see your strategy, and also I would like to ask your final thoughts from today's session as well.
Sure. So the recap is this. If you're somebody that is in a long trade and sees a short trade in the same name you want to take, or the other way around, if you're in a short trade and you see a long trade that you want to take in the same name, and you're one of those people, I should have clarified this, that likes to do them in separate accounts so that you can watch one and the other separately. And I would say you should watch them separately. You want to have a personal back office so that you can do them in the same account and save the borrowing fees in your short account and save any other double fees you might have depending on the broker. So just real quick, I'm going to share this screen one more time just to explain that better. And I think Landry, what I have are two back office sheets, and I call these my personal back office. This is the long sheet, and this is the short sheet. Okay? I don't know why short's not in here. I created this for you guys, so I didn't put it in. All right. Right now, in theory, I have a long trade and a short trade. I don't really have these trades on right now. So don't take these trades. Don't take them on my advice. You can take them if you want. But the symbol in this particular example, okay, is FANG. And FANG was bought at about 141.24, and the target is about $215, long 25 shares. Okay, right now to my portfolio, that's a gain of about 14%. And the stock itself is up about 40% from this price. Okay. Now, if I were to see a short position, and I'm one of those people that puts them in two separate accounts so I could track them differently. And by the way, it is important to track each trade so that you know which strategies need improvement. So let's say I have a short strategy that triggers a short trade, but I'm not at my target yet. Okay. I go in here and I formulate the short trade. Now, I already showed the position size calculator. I can show it again really quick. And this is how they would look. Here's my long trade, 2% risk on a $10,000 account, entry price, stop price, number of shares, 25. And then my long trade, my short trade, entry price, stop price, and number of shares is short 23. So long 25 versus short 23. Some people might look at this and say, well, I have to do that in two separate accounts. Otherwise, I have to cover the long trade. I'm saying cover 23 of the long trade in this example. And you track them separately in, again, what I call your personal back office. Okay. So the long trade is in this tab, long 25, 14% gain. And the short trade, which is entry price of 203.50, short 25 shares with a stop of $212. That trade, the stock is down 2.9% for a 1.34% gain to my portfolio. Now, the net effect of this is I'm long 2 shares of FANG. But in your personal back office, you need to track them both separately, especially if they're different signals. Okay, in this particular example, for the way that I trade, they are 2 different signals. One is a rotation zone with a GAN extension stop, and the other one is a double top. So in order to keep my trading pure, I need to track them separately. Okay, and I need to see how well did my short trade do? How well did my long trade do? So that I know how much risk I need to allocate to the 2 strategies over time. And this is the way you do it without needing a separate account that you have to borrow the stocks into, because there's a cost to borrowing shares to short them. When you do it in the same account, as Landry pointed out, you don't have to borrow the stocks. You just sell the ones you already have, but you have to track them. So I'm tracking the short position and I'm still tracking the original long position separately So I know what each one contributed to my P&L. And then when you get to the target of the short trade, you add the 23 shares back into the long trade by buying them, which is covering the short trade. Sounds like a lot of double speak, but when you play around with it, it's really, really simple. And it's very intuitive, right? And this way you don't have to skip a trade just because you have a trade in a current stock and you don't want to incur costs in another account. Remember, you have to fund both accounts if you have two separate accounts, one for long and one for short. With this particular method of having a personal back office, you don't have to fund another account. You just do everything in the same account without excess fees and trading costs.
Amazing tip. Would you like to leave us with the golden nuggets or final thoughts from this today's session?
Yes, you can be synthetically long while short or synthetically short while long without trading options. Okay, you can do that. So if options are a mystery to you, this is how you do it. And I would recommend those of you that have TradeZero accounts to watch the replay of this, especially the summary. Thank you, Badish, for asking me to do that. Because really the summary is what I should have started with, right? Rather than going through all the steps.